In the previous chapter, we introduced the four financial statements. We discussed how these statements provide information about a company's performance and financial position. In this chapter, we extend this discussion by showing you how to prepare a classified balance sheet. Now we'll look at specific tools that you can use to analyze financial statements in order to make a more meaningful evaluation of a company. We will use ratios to evaluate a company's profitability, liquidity, as well as solvency. Ratio analysis expresses the relationship among selected items of financial statement data. A ratio expresses the mathematical relationship between one quantity and another. A single ratio by itself is not very meaningful. As a result, we will use various comparisons to shed light on a company's performance. Intra-company comparisons will make comparisons covering 2 years for the same company. So we'll take a look at the current year and the prior year. Industry average comparisons are based on average ratios for particular industries. And then finally, intercompany comparisons will be comparisons based on a competitor within the same industry. When analyzing financial statements, we classify ratios as profitability, liquidity, or solvency. Profitability ratios measures the income or operating success of a company for a given period of time. Liquidity and solvency ratios measure a company's ability to pay its debts and obligations. Liquidity focuses on the short term, whereas solvency focuses on the long term. We'll introduce you to a few ratios in this chapter, as well as introduce additional ratios throughout the semester. We will be analyzing the financial statements of Best Buy. Best Buy generates profits for its stockholders by selling electronics. The income statement reveals how successful the company is at generating a profit from its sales. The income statement reports the amount earned during the period, revenues, and the cost incurred during the period, expenses. It essentially assesses performance. Best Buy sales have decreased from 2016 to 2017, but net income increased during this period. Net income increased from $897 million to over $1.2 million. Despite the company's revenues decline, net income increased due to a significant decrease in expenses. Earnings per share measures net income earned on each share of common stock. For now, a basic approach for calculating earnings per share is to divide the earnings available to common stockholders by weighted average common shares outstanding during the year. Earnings available to common stockholders is calculated as net income minus dividends paid on another type of stock called preferred stock. By comparing earnings per share, we can evaluate its earnings performance. Best Buy's earnings per share increased from $2.65 to $3.87. This increase occurred because its net income increased and its outstanding shares decreased. It is really important to note that comparison of earnings per share across companies are not meaningful because of the wide variations in the number of shares of outstanding stock among companies. Corporations are required to disclose earnings per share on the income statement. You typically see it right below net income or in the notes to financial statements. This ratio is widely used in evaluating the operating performance and profitability of a company. Please pause this video and solve for earnings per share. I hope you selected A, or $4. Again, that was calculated by taking net income of $26,000 and subtracting the preferred stock dividends of $2,000. Our average shares outstanding are 6,000, so our earnings per share is $4. Best Buy uses the following classifications. It identifies its current assets, and then it lists its property and equipment, and then finally other assets. You can learn a lot about a company's financial health by evaluating the relationship between assets and liabilities. In the liability and stockholders' equity section of the balance sheet, the first grouping is current liabilities. The second grouping is our long-term liabilities. And then finally, within our stockholders' equity section, we're going to list common stock followed by retained earnings. Short-term creditors are interested in liquidity. For example, a banker who is considering lending money to Best Buy would be concerned about Best Buy's liquidity. That is, its ability to pay obligations expected to become due within the year. A classified balance sheet makes it easy for us to calculate working capital because it classifies its assets and liabilities as either current or long-term. Working capital is the difference between the amount of current assets and current liabilities. When current assets exceed current liabilities, working capital is positive. When this occurs, there is a greater likelihood that the company will pay its liabilities. When working capital is negative, a company might not be able to pay its short-term creditors. Best Buy had working capital in 2017 of $3.394 million. Liquidity ratios measure short-term ability to pay maturing obligations as well as meet unexpected needs for cash. One liquidity ratio is the current ratio, which measures the relationship between current assets and current liabilities. Current assets are in the numerator and current liabilities are in the denominator. A comes before L, so I like to think of assets are on top and liabilities are on the bottom or in the denominator. The current ratio is a more dependable indicator of liquidity than working capital. Two companies with the same amount of working capital may have significantly different current ratios. This slide shows the 2017 and 2016 current ratios for Best Buy and H.H. Gregg. Best Buy's 2017 current ratio of $1.48 to 1 means that for every dollar of current liabilities, Best Buy has $1.48 of current assets. Best Buy's current ratio increased in 2017. Best Buy's liquidity is lower than H.H. Gregg's, but not significantly so. Now suppose that instead of being a short-term creditor, you are interested in either buying Best Buy stock or extending the company a long-term loan. Long-term creditors and stockholders are interested in a company's solvency, and that is its ability to pay interest as it comes due and to repay the balance of debt at its maturity. Solvency ratios measure the ability of a company to survive over a long period of time. The debt-to-asset ratio is one measure of solvency. It is calculated by dividing total liabilities, both current and long-term, by total assets. Here's a hint. The title or the name of this ratio is debt-to-asset ratio. Debt is listed first, so I want you to put total debt in the numerator or on top, and assets is listed second, so total assets are in the denominator or on the bottom. It is a measure of the percentage of total financing provided by creditors rather than stockholders. Debt financing is riskier than equity financing because debt must be repaid, whether the company is performing well or not. The higher the percentage of debt financing, the riskier the company. So the higher the percentage of total liabilities or debt to total assets, the greater the risk that the company may not be able to pay its debt as they come due. The 2017 ratio of 66% means that every dollar of assets was financed by 66 cents of debt. Best Buy's ratio is similar to H.H. Gregg's ratio of 69%. Debt financing differs greatly across industries. Here are some debt-to-asset ratios for selected companies in a recent year, and we're going to focus on the difference in the debt-to-asset ratio of Microsoft and General Motors. The first thing I want you to think about is, what do these companies produce? Microsoft is responsible for Office, which I personally can't live without this software. I use Excel, Outlook, PowerPoint, and Word every day. My son would say he can't live without Xbox, and I have quarterly credit card statements that would prove that. GM, on the other hand, is responsible for the production of the GMC and Cadillac models, as well as other automobiles. Microsoft has a lower debt-to-asset ratio than GM. The company is in a rapidly changing industry and should try to minimize the risk associated with increased debt. Microsoft also generates significant amounts of cash, and I can prove that with my credit card statements. And it has relatively less need for large investment in plant assets, so it does not need to borrow a lot of cash, whereas GM needs to make huge investments in plant assets and has a very large credit operation. As a result, GM has a large borrowing need. In the statement of cash flows, net cash provided by operating activities is intended to indicate the cash-generating capability of the company. Most analysts, when they look at the statement of cash flows, look at that net cash provided by operating activities to see if the company is generating enough cash by its operations alone. Analysts have noted, however, that the net cash provided by operating activities fails to take into account that a company must invest in new property, plant, and equipment, or capital expenditures just to maintain its current level of operations. Companies must also maintain dividends at a current level to satisfy investors. A measurement to provide additional insight regarding a company's cash-generating ability is free cash flow. Free cash flow describes the net cash provided by operating activities after adjusting for capital expenditures and dividends paid. Free cash flow is calculated by taking the net cash provided by operating activities, again, that's found on the statement of cash flows, and subtracting capital expenditures as well as cash dividends. MPC produced and sold 10,000 personal computers. It reported $100,000 of net cash provided by operating activities. In order to maintain this level of production, MPC invested $15,000 in equipment. It also paid $5,000 in dividends. Its free cash flow was $80,000, and that was calculated by taking $100,000 of net cash provided by operating activities and subtracting the expenditures of $15,000 as well as the dividends of $5,000. The company could use this $80,000 to purchase new assets to expand the business, pay off debts, or increase its dividend distribution. In this exercise, you will calculate the ratios we just discussed. Please open the handout document for this chapter to obtain the condensed balance sheet and income statement. The solutions to this problem will be provided in the next video.